Imagine this scenario and really picture it. You wake up one morning and every single stock quote, every flashing ticker, every daily price change, it just disappears for the next 10 years.
Gone.
Gone. You can't sell. You can't buy. You can only look at the business fundamentals. The question is, would you still sleep well knowing that you are locked into the businesses you own?
That is the ultimate thought experiment for the intelligent investor, isn't it?
It is.
It forces you to adopt Benjamin Graham's core question. If you are fundamentally an owner, not a trader, what actually matters? And the answer, which he lays out with incredible clarity in Chapter 19 of The Intelligent Investor, is sharp. What matters is management behavior and specifically what they do with the company's cash.
Welcome to Capital Allocation Lab. Audio-first lessons that turn classic investing ideas into practical decisions for long-term owners.
If you are joining us, this channel is strictly for long-horizon, fundamentals-minded investors. We are talking about the people who prioritize enduring wisdom, like that found in The Intelligent Investor, over chasing the daily headlines.
Yeah, our focus is really on judgment, not on forecasts.
Exactly.
Today we are embarking on a deep dive into Chapter 19 titled Shareholders and Managements, Dividend Policy. And we're updating Graham's principles for the modern era of complex compensation, massive buybacks, and global growth.
We will be discussing how to effectively judge a management team, spotting those capital allocation red flags, understanding the true nature of buybacks and stock dividends.
And crucially, how to finally start thinking like a business owner.
If that kind of sustained discipline analysis sounds useful to you, please take a moment and hit like and subscribe. It's a very small action, but it tells the algorithm that there are serious investors out there seeking this kind of material, and it genuinely helps us continue building this library of evergreen lessons.
All right, let's leave the noise of the daily market behind us and step into Graham's lab.
The foundational observation that Graham starts with is, frankly, uncomfortable. It's the uncomfortable truth that he observed throughout his career.
Which is?
That most shareholders behave terribly as owners.
It's the shareholder's paradox, defined. In theory, you are at the top of the food chain. You own the business. Management are, by definition, hired employees.
They work for you.
The board is supposed to represent your interests. The company's cash is fundamentally your cash. You are the boss.
But in practice, Graham says the average public shareholder is essentially a complete washout. He noticed that for decades, investors would dedicate 99% of their mental energy to obsessing over the stock price.
The short-term moves, the daily volatility.
Right, and 0% of their energy to scrutinizing what management was actually doing with the company's retained cash or the underlying operating business.
That rings so true today, even with far more transparency. The moment a stock starts moving, investors stop thinking about the business as a productive asset and start thinking purely about momentum or price targets or technical analysis.
Graham wants us to pull back, ignore the noise, and recenter ourselves on the quality of the stewardship.
So how do we do that?
Well, to help us filter out that market noise and focus on enduring business reality, Graham gives us a critically simple, yet rarely applied, three-part test for when owners are actually justified in raising questions about management's competence.
And this isn't for a bad quarter, right? This is for chronic failure.
Exactly. The three conditions must be met simultaneously. First, operating results are unsatisfactory in themselves. They aren't meeting basic standards of profitability, return on capital, or operational efficiency for the sector.
So they're simply not doing a good job running the nuts and bolts of the business?
That's it. Second condition, those operating results must be demonstrably worse than peers in similar businesses. So if the whole industry is facing a severe recession, that's one thing.
But if this specific management team is underperforming all of its rivals during the same period, that highlights a unique problem of competence.
Precisely. And the third leg of the stool.
The stock price. It has to have been weak for a long time as a direct result of that sustained poor business performance. The market, over years, has rendered a negative verdict because of the operational failures.
It is so important to note what is excluded from this test. Graham is explicitly telling you to ignore temporary setbacks.
Like a bad quarter that missed analyst estimates.
Or a scary headline about a product recall, or a temporary dip caused by an exogenous recession. None of that counts.
You need years. We are talking 5, 7, or 10 years of comparative underperformance, both on the balance sheet and in the stock market, before you have sufficient justification to act or demand change.
It has to be chronic, systemic underperformance, verified by the market's judgment.
This clarity is so crucial. It prevents the intelligent owner from selling out of fear over every temporary downturn. He's not saying fire management every time the stock dips 5%.
Not at all. He's saying if the business has fundamentally underperformed its potential and its competitors for half a decade, and the market has correctly punished it for half a decade, then owners are absolutely right to start asking hard questions.
Now, we must face the second uncomfortable truth, which is related to the first. Graham notes that poor managements are rarely, if ever, thrown out by the great mass of public shareholders.
This is a blunt but historically grounded perspective. The average investor simply does not have the time, the resources, or the coordination to mount proxy fights or attend annual meetings.
We're too diffuse.
Exactly. So change, therefore, usually only happens when a determined individual or a small, organized group, an activist investor, often focused on value, accumulates enough stock to truly wrest control. And they usually do this when the price has been depressed due to years of that poor performance.
They buy cheap and fix it.
That's the model. The sobering takeaway for the average person listening to this is that our activism is often just selling quietly at a depressed price. We exit the problem,
Allowing a more energetic, financially powerful outsider to step in, buy control cheaply, and take on the hard work of turning the business around.
Right. So if you are a long-term investor today, the goal isn't necessarily to plan to become an activist. The goal is to shift your personal behavior from being a passive price watcher to an engaged business owner, using Graham's tools to evaluate management before you commit your capital.
So you don't end up in those chronically underperforming situations in the first place.
That's the whole point.
That shift in mindset, it takes us directly to the two foundational questions Graham provides. If you adopt the ownership mentality, these are the two basic things you must ask management.
And they frame everything that follows about capital allocation. Question number 1, is management reasonably efficient at running the business? That means the operational side of things.
And question number 2,
Are the interests of outside shareholders being properly recognized? This is the capital allocation piece, the financial efficiency.
okay, let's break down question 1 first. This is the stuff we spend most of our time on. It's about the day-to-day work, right?
Yeah. Running the stores, managing the factories, maintaining the code base, negotiating supply chains, refining the product mix, all of that.
And you judge this using your standard financial toolkit. Profitability, stability, market share, growth rates, returns on capital, all compared against industry peers. Are they good operators?
Do they generate cash efficiently? That's the core of it. But question 2 is where the intelligent investor separates from the crowd, because this is entirely about financial efficiency, not operational performance.
So once the business generates $1 of profit, what happens next?
Exactly. Does management pay a sensible dividend? Do they retain cash and actually compound per share earnings? Or do they pile it up, squander it on low return vanity projects, or, primarily use it to enrich themselves?
This distinction is the single most important idea in this chapter, I think.
It really is. A company can be operationally excellent, making fantastic products, dominating a market, boasting high margins, but still be financially inefficient, destroying shareholder value through poor allocation decisions.
Give us an analogy there, because it's a little counterintuitive. How can a company be great at its core job, but terrible for its shareholders?
Okay, think of it like a highly skilled carpenter. They can build the most beautiful, functional, custom furniture in the world. That's operational excellence.
Right.
But if they take all the revenue, put it in a shoebox, and then spend it on buying tools they never use or a third workshop they don't need, they might be comfortable. But the owners of the carpentry business haven't seen a return.
The operational brilliance is nullified by financial laziness or self-interest?
Perfectly put. And Graham's warning about this misalignment is very pointed. The typical management team inherently wants as much capital as possible under their control.
Of course. More cash on the balance sheet makes their job safer, gives them more flexibility, and often provides them with more personal comfort and power.
But that manager preference for hoarding capital, however, is often not the best use of your capital as a shareholder. They see it as prudence. Graham might see it as potential waste, especially if that cash is retained when high-return investment opportunities are scarce.
So, your duty as an owner is to transcend the superficial, the product is great assessment. You have to ask the difficult, uncomfortable question. Are they using my capital intelligently to increase my per share value? Or are they just hoarding it under the guise of prudence, essentially sitting on my money?
That scrutiny defines intelligent ownership.
That deep scrutiny leads us directly into dividend policy, which, in Graham's era, was the most transparent signal management could send about capital allocation.
Yeah, and we have to place this in historical context. When Graham was writing, the historical norm for a typical, healthy, non-speculative industrial company was to pay out a significant proportion of its earnings.
How significant?
We are talking about 60% to 75% as cash dividends.
60 to 75%. That is an astounding number by modern standards, where so many strong, highly profitable companies pay zero. Why was that such a high norm?
Because the mindset was fundamentally different. Investors often saw retained profits, the cash kept by the company, as a potential negative. It was associated with weaker companies that needed the cash simply to survive.
Or management teams that couldn't find good opportunities and were therefore implicitly saying, we don't trust ourselves to generate high returns.
Exactly. And the market's behavior reflected this preference. Investors liked and generally valued liberal dividend payers more highly. Companies that held on to most of their earnings often traded at lower valuations specifically because the market applied a trust discount.
They didn't trust that retained cash would ultimately be translated into tangible per-share future value.
Right. The great shift happened post-World War II. You started seeing truly explosive growth companies. Graham points to examples like Texas Instruments and Superior Oil, which deliberately paid little or no dividends.
And because their earnings growth and subsequent stock price explosion was so dramatic, the market entirely approved of the retention policy.
The market was signaling, we don't need the income now, just grow the pie as quickly and profitably as possible. This is the foundation of the modern, profitable reinvestment thesis.
The rationale sounds compelling. Management argues we can compound your capital at high rates inside the business, higher than you could possibly achieve on your own.
If we pay out cash, you'll just reinvest it at a lower return. Trust us to keep it.
And crucially, if a company genuinely has high return opportunities, projects that consistently earn 20–30% or more on capital and can be scaled for a long time, retaining cash and paying zero dividend is absolutely the best course of action for the shareholder.
No one would argue with that. But here's where Graham forces accountability, regardless of the growth narrative. His demand for shareholders is non-negotiable. Shareholders must demand one of two concrete, measurable outcomes from management.
This is the payout test.
This is the payout test. Option 1, a normal payout of earnings on the order of, say, 2/3. A generous and consistent dividend that confirms management has surplus cash beyond what is needed for necessary operations and modest growth.
Well,
Option 2, or a clear-cut demonstration that the profits that were retained and reinvested have actually produced a satisfactory corresponding increase in per-share earnings.
this shift to per-share metrics is the core genius of Graham's analysis here. The measure of success is not just that the business got bigger or sales are up 10%.
No. The real scoreboard is, did each single share you own become measurably more valuable, more profitable because management kept your cash?
Let's run a detailed mental scenario. A company earns $5 per share. If they pay out $4 and retain $1, that $1 needs to be productive.
Right. If 10 years later that $1 of retention has driven earnings per share up by 60%, the retained cash was productive. The shareholder sacrificed $1 of immediate income for a higher, compounded future cash flow. That works.
But now consider the much more common scenario. The company retains $4 and pays out $1. 10 years later, per-share earnings are stagnant, maybe up under 5% over the decade.
In that case, the owners sacrificed $40 over those 10 years for virtually no long-term return. The retained cash was unproductive and the owner was worse off.
And Graham says for many companies that exhibit a low payout combined with stagnant per-share results, this disconnect is the direct cause of the stock price being below fair value.
The market applies a discount for hoarding because they simply do not trust management to allocate the retained earnings productively.
He also preemptively dismisses the common management excuse that we companies use, holding down dividends to expand the business.
Right, which sounds noble, but Graham advises owners to be highly skeptical of expansion claims. His reasoning is brutal, but logical.
If the business has a mediocre or poor record, and the same management is now asking you to fund major expansion efforts with your withheld dividends,
there is no reason a priori to believe that owners will benefit. If they couldn't generate good returns on the old capital, why should they suddenly be able to generate strong returns on the new capital?
So the modern application of the payout test remains identical. If the payout is modest, are per-share metrics compounding at rates that justify the retention? Or is management just using growth language to cover up mediocrity in empire building?
That question is vital for assessing long-term quality.
Moving from cash allocation to paper allocation. Chapter 19 also deals with two concepts that still generate a lot of market excitement, but confuse many investors.
Stock dividends and stock splits, both are classic examples of form over substance.
Let's start with the split because it's the most straightforward. A stock split is purely a restatement of the share structure, say a 3-for-1 split. You now own 3 times as many pieces of paper.
But the total pie you own is exactly the same size. Exactly. No new value has been created, and your percentage ownership in the business remains precisely unchanged.
It's often just done to make the per-share price look more accessible to smaller investors.
That's usually the reason. Now, a stock dividend, especially the type Graham discusses, is slightly more nuanced. Graham defines it as a small stock dividend, typically around 5% or less, which is explicitly meant to formally capitalize earnings that were recently retained and reinvested in the business.
As it's a balance sheet action, an accounting transfer.
An amount is moved from earned surplus, which represents accumulated profits, to the capital accounts. The transfer formally links the stock dividend received by the shareholder to the retained profits.
So the company is literally saying, we kept your cash, we invested it, and here's a new piece of paper that formalizes your increased ownership claim on those retained earnings.
Yes, and Graham argued this provided a practical, not just theoretical advantage. If you needed cash, you could sell that newly received stock dividend without breaking up your original certificate. It was a tangible way to receive some value without disrupting your core holding.
Now, most academics today tend to dismiss both splits and small stock dividends as mere paper shuffling.
They do. They argue that since the underlying ownership percentage hasn't changed, nothing of economic value has transpired.
But Graham pushed back on this academic rigidity.
He did. He argued that the pure paper shuffling view ignores 2 powerful factors: the psychological effect and potential tax efficiencies.
How so, psychologically?
Well, many intelligent investors did treat a systematic small stock dividend as a tangible, regular reminder that earnings were being successfully reinvested on their behalf. It reinforced trust. It was a mechanism for management to communicate in a transparent way. We are compounding your money, and here is your official receipt.
But the core principle, again, must not be forgotten. You have to look beyond the form.
Absolutely. A stock split or a small stock dividend does not create intrinsic value by itself. What fundamentally matters is the underlying earning power and the discipline of the capital allocation that preceded the action.
So if a company announces a highly publicized split, but the business is stagnant and profitability is low,
that split is just theater. It is a distraction, not a justifiable reason for a higher valuation. Graham valued policies that were clear and transparent about stewardship, not just flashy.
let's return to that foundational ownership mindset. The principle that defines this chapter is, when you buy a stock, you become an owner of the company. Its managers work for you. Its cash belongs to you.
The problem, as we noted, is the disconnect. Most modern investors expend massive effort on the entry and exit points, the buying and selling, and almost none on the actual ongoing work of owning the business.
Which is governance.
And if you are going to act like an owner, you need a readily available tool. And that tool, which companies are legally required to send you before the annual meeting, is the proxy statement.
This document is your window into the internal mechanics of the company, revealing things the annual report often glosses over.
It's where you see exactly who the directors are, the specific methodology of management compensation, how much stock insiders actually own, and critically, details on related party transactions.
Related party transactions. Those are the deals between insiders, the management, the directors, or their close associates, and the company itself.
And this is where the self-dealing red flags often first appear.
The Enron case study, tragically, provides a perfect, timeless illustration of why reading that proxy with a critical eye is so essential.
It happened decades after Graham's death, but the principle was the same. Long before the company imploded, the warning signs were clearly visible in the governance section of the proxy.
Detail that for us because it really crystallizes the ownership mindset in action. What were the specific red flags?
Well, the Enron proxy showed that the chief financial officer, key management, was operating various private partnerships. These partnerships were entering into transactions to buy assets from Enron. And even worse, the CFO was financing these purchases using capital provided by Enron itself. This structure allowed the CFO to potentially profit personally when those deals were favorable to his private partnerships.
Placing his interest directly against the company's interest.
Exactly. You didn't need to be a forensic accountant specializing in complex energy derivatives to understand the conflict. Just reading that proxy should have triggered a very simple common sense question.
Why is the CFO on both sides of the trade? Why is the company lending capital to its own partnerships?
That is Graham's ownership mindset in action. You don't need to lead a crusade, but you must read what the company is legally required to disclose and apply basic questions of stewardship.
Does this look like a management team that is prioritizing outside shareholder value, or does it look like self-dealing?
And if you don't like what you see, you have direct tools. You can vote against directors up for election. You can withhold support on excessive or poorly structured pay packages.
And of course, the ultimate, most powerful vote you cast is the choice not to own the stock at all.
Graham, aiming to formalize accountability, even suggested something quite forward-thinking for his time.
What was that?
He suggested that independent directors should issue a separate annual report directly to shareholders. This report would address the crucial question: is this business producing the results for outside stockholders that should be expected under proper management? If not, why and what steps should be taken?
Wow. That level of mandated candor would entirely change the dynamic of management reporting today. It forces managers to focus explicitly on outside shareholder results, not just the growth of the overall enterprise.
That brings us directly into the biggest modern complexity that has altered the landscape since Graham wrote: the intertwined relationship between buybacks, stock options, and traditional dividends.
Let's start with buybacks in principle. In theory, they're an excellent use of surplus cash, but there's a big if, right?
A huge one. If the stock is clearly undervalued, a repurchase reduces the share count, which means the remaining slice of the business owned by the remaining shareholders is automatically larger.
It's the pure private owner mentality. If you know your business is intrinsically worth $1 and you can buy out a departing partner for 60 cents, you have just created 40 cents of immediate value for yourself and the remaining partners.
It concentrates ownership and increases per share value. Simple. However, the reality today is severely complicated by the options problem. Modern executive compensation relies heavily on issuing stock options and restricted stock units.
And when executives and employees exercise these options, they create new shares, increasing the total share count. That's dilution.
Exactly. So we see the true purpose of many buybacks: cash being spent not to shrink the share count and concentrate ownership, but simply to absorb the new shares issued via compensation.
So they were running hard, spending massive amounts of shareholder cash just to stand still.
Just to stand still, offsetting the dilution created by stock-based compensation.
The commentary notes a profound conflict of interest here. You have firms spending huge portions of their earnings repurchasing stock, often at high or average prices,
while simultaneously issuing stock cheaply to insiders via those options. This is effectively selling low to insiders and buying high in the market.
That is the absolute antithesis of intelligent capital allocation discipline.
And there's an additional subtle conflict tied to incentives. Executives who are heavily compensated via options have an incentive to favor buybacks over dividends.
Why is that?
Because options are generally more valuable when the stock price is volatile and trending upwards. Dividends, by returning cash regularly and reducing uncertainty, tend to reduce volatility.
So the incentive structure subtly encourages managers to withhold stable dividends, which Graham viewed as essential proof of stewardship, in favor of buybacks, which can often be used to maximize their own personal option gains.
This brings us back to the heart of Graham's simple principle. Most managers, regardless of the complexity of our compensation package, are simply wrong when they claim they can always put shareholder cash to better use than the shareholders can themselves.
The benefit of paying a sensible dividend, therefore, isn't just the income. It fundamentally improves average outcomes over time by removing surplus cash from management's immediate discretion before it can be squandered.
Or unnecessarily hoarded, or used simply to mask dilution. It forces discipline. And the research supports this later on. We saw that firms that established policies of paying and consistently raising dividends often showed superior long-term earnings growth and better stock returns,
Compared to firms that retained everything and paid low or zero dividends.
Right. The act of sharing capital seems to correlate strongly with management discipline.
This doesn't mean we should automatically reject every low payout growth stock.
Of course not. But it does mean we must maintain a high level of skepticism for the blanket statement, "We're reinvesting everything for your own good," especially when that narrative is conveniently paired with aggressive buybacks that mostly offset dilution and massive option grants for executives.
So the ideal scenario, which respects both Graham's demand for accountability and the modern need for growth, is a blend.
A blend. A sensible, sustainable dividend that confirms stable profitability, plus opportunistic buybacks when the stock is genuinely and clearly cheap relative to intrinsic value.
The critical word there is opportunistic. The buyback should not be an automatic mechanical feature of the company's financial engineering.
Which they often are today, driven purely by the need to offset stock-based compensation.
And that leads us to the final point on governance: executive compensation. We have to look past the large numbers and ask if those stock options truly align management with the long-term per-share results for outside owners.
Or if they just enrich managers based on broad market moves. Alignment only truly exists if options pay off when the business significantly and sustainably outperforms its peers over a long period, say 5 to 10 years.
If they pay off simply because the entire market rose, or because management took on excessive leverage and risk for short-term pop, the alignment is entirely weak.
And the most practical detail that betrays the ownership intent is this. Many executives exercise their options and immediately sell the stock. They are treating those options exactly like a large cash bonus, not like a long-term ownership stake in the business.
That immediately signals a lack of true owner mentality on the part of the executive.
It does.
As an outside shareholder, you can't rewrite the entire compensation plan, but you must be an intelligent owner when you vote on those compensation proposals. You need to ask yourself several critical, fact-based questions before casting your vote.
Question 1. How large are the total option grants as a percentage of shares outstanding? Is the dilution minimal, or are we talking about 5 or 10% of the entire company being handed over to management?
Question 2. Are these options tied to meaningful long-term performance metrics against an appropriate benchmark? Or are they just time-based rewarding management for simply staying in their chairs for 4 years?
And question 3. Regarding true alignment. Do the executives hold meaningful amounts of stock, outright stock they actually paid for? Or do they immediately sell shares after exercising, treating the options purely as cash compensation?
The commentary sums up the entire issue of pay and results with the ultimate owner's verdict. No CEO ever deserves to make himself rich if he has produced poor results for you.
That is the highest standard of accountability. If they haven't demonstrably made you wealthy over the long run as the owner, they should not be making themselves wealthy, period.
Okay, let's synthesize all these principles from Graham's Chapter 19 and the modern commentary into a practical, actionable tool.
Right. If you are serious about shifting from a passive price watcher to an active business owner, this is the checklist you need to apply when researching a potential investment or reviewing a current one.
We've assembled a Graham-style ownership checklist with 7 essential points, tuned specifically for the long-term investor in today's complicated market.
Let's do it. 1. The results test. You need to look beyond the latest quarter. Over a full business cycle, think 7 to 10 years, have the per-share metrics, specifically EPS, cash flow per share, and returns on capital, been satisfactory relative to industry peers?
And if the answer is no, and the stock has lagged the market for a long time, you must not blame the market or external factors.
No. The first suspicion must fall on management. Graham's test forces you to recognize that systemic underperformance over years is an indication of poor stewardship, not just market inefficiency.
Okay. Number 2, the payout test. This is Graham's non-negotiable demand. Does the company meet one of the 2 conditions? Either a reasonable dividend payout that acknowledges surplus cash,
Or compelling documented evidence that the retained earnings translated directly into strong per-share growth. If you see a low payout combined with weak or stagnant per-share growth, that is a serious flashing yellow flag.
it means management is comfortable hoarding capital but lacks the discipline or opportunity set to deploy it productively for the shareholder.
Exactly. 3. The capital allocation narrative. You need to read the CEO's letters, presentations, and shareholder communications with intense focus and skepticism.
Are they providing clear, coherent explanations of why they retain or pay out cash? Do you see evidence of discipline in acquisition history, or do they overpay consistently?
Look for signs of honesty. Management that is truly excellent at capital allocation usually owns up to past mistakes, explains why they failed, and articulates a clear learning process.
Discipline and humility are often the best indicators of a high-quality allocator. Avoid those who spin constant success stories.
Right. 4. The balance sheet and cash pile. If the company is sitting on a massive cash hoard, demand a clear, detailed, articulated plan for its deployment at high rates of return.
Remember Graham's blunt warning here. So long as surplus cash remains with the company, the outside stockholder gets little benefit from it. It is your capital, and if it's earning 1% sitting in a bank account, it is functionally being squandered.
Totally. 5. Buybacks and share count. This requires quantitative work. Track the trend in shares outstanding over a period of 5 years.
If management is touting large buyback programs, but the share count is flat or barely shrinking, recognize the truth. That cash is almost certainly just offsetting stock-based compensation dilution.
Be realistic about the achievement. If you see $5 billion spent on buybacks, but the share count has only decreased by 0.5%, the cash was used defensively to maintain your current ownership percentage, not aggressively to concentrate it.
Okay, number 6, governance and conflicts. This means reading the proxy, not just skimming the annual report. Look specifically for related party transactions.
Any sign that executives are on both sides of a trade with the company, scrutinize the compensation structure. If executives are engaging in self-dealing, or if the pay disparity is massive and untethered to the long-term results they produce for you, you might simply choose to avoid those situations altogether.
And finally, number 7, your own behavior. This last point is reflective. Are you actually acting like the owner you claim to be?
Do you read the annual report, the 10K, and the proxy statement before committing serious capital? Do you vote your shares, or do you let your broker vote them by default?
Ownership requires engagement. Graham's message is ultimately about accountability, not activism. Remember, when you buy a stock, you are hiring a management team to steward your capital.
And you have every right to expect clear explanations, sensible policies, and demonstrable evidence that your specific share of the business is becoming more valuable over time.
Let's summarize the 3 core ideas from this deep dive into Graham's Chapter 19 that every long-term owner must remember.
Okay. 1. Shareholders are owners, but they rarely act like it. The intelligent investor ignores the noise of the daily price and watches management's long-term operational results and capital allocation behavior.
2. Dividend policy, or the lack thereof, is the single most critical window into capital allocation. Management must either pay out a reasonable share of earnings or show convincingly that retained cash is compounding your per-share value.
No excuses for hoarding capital unnecessarily.
And 3. Form doesn't equal substance. Stock splits, stock dividends, and especially buybacks only matter if they are tied to genuine, long-term economic benefits for outside owners, not simply offsetting compensation or creating temporary market excitement.
At Capital Allocation Lab, our mission is to teach disciplined, long-term investing using these classic ideas, translating that timeless wisdom into practical judgment you can apply today without hype, trading forecasts, or complex jargon.
If this extensive discussion was helpful to you, it would mean a lot if you tap like and subscribe. It's a small action on your side that makes a big difference in how far these evergreen lessons travel.
And we genuinely want to hear from you. Drop a comment below with your specific questions about dividend policy versus buybacks, examples of companies you think treat shareholders exceptionally well or badly, or which fundamental investing concept from the intelligent investor you'd like us to explore next.
Yeah, tell us if you need a deep dive on margin of safety, or how to calculate owners' earnings, or a step-by-step guide to reading an annual report like an intelligent investor. We build these sessions based on your feedback.
Thanks for spending this focused time with us.
Thanks for joining. If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.
See you in the next session of Capital Allocation Lab.